discuss a topic, are hedge funds still low costs? And interviewed will be by Will Wainewright, Dr. Sofia Harrschar, Head of Alternative Investments, Universal-Investment. Sofia, please. And will introduce with more detail in the background. Thank you.
Sofia, your mic is just there. Thank you for joining me. And I should say, that title is very much a cheeky starting point and is not an insult to Dave Fishwick, who has just left. So let me start by asking you, Dr. Sofia, could you just introduce yourself and your organisation?
Very happy to do. Does this work? Yeah, it does. So Sofia Harrschar, I'm the head of alternative investment and our country head of our Luxembourg operation at Universal-Investment. Universal-Investment is the largest German and one of the leading European management companies and fund administration platforms with 970 billion euros on our platforms. In the alternative space, we've got about 95 billion euros invested capital, and in about 240 different structures. We started these operations about 10 to 12 years ago, and it's been quite growth since then, but I think we'll get into more details about the alternatives markets in a second.
Great. We're going to explore the growing interest, the growth in alternative investments in recent years in Germany and beyond. There have been some changes, the title referring to hedge funds as locus, that harks back to a time before 2008 when there were certain activist attacks, and then we had the crisis, and hedge funds never really had that breakthrough in Germany. Has that changed at all, or do you still think other alternatives are preeminent?
When one looks back, and before joining Universal, I was working with a hedge fund company. So actually, I do remember the years in the early 2000s quite well. At the time, the US, American, and Anglo-Saxon world had a rather strong investment base into hedge funds, whereas in Germany, it wasn't that well known, partly because the regulation actually did not allow for short selling as much in the German fund structures, which made it rather difficult. And also from a tax perspective, it was rather cumbersome to invest into hedge funds because of various declarations and punitive taxes that were imposed. Once the market kind of started to take off in the early 2000s, we didn't then have both the Madoff disaster as well as the financial crisis, which basically took away strong interest from large German investors into the hedge fund market. Also, one has to say that at the time, probably most of the market was driven by high net worth individuals. It was more the wealth asset managers that actually, and driven very much by large investment banks, be it the large Swiss banks, be it some large US American banks that were taking hedge funds into Germany. The appetite got lost, quite understandably so, and it has not really come back. So when we talk about alternatives these days, at least the portfolio that we manage and administer, we do have a significant portion of hedge funds, and it's starting to come back very slowly in the last, say, 2 to 3 years. Very much linked to, I think, the COVID pandemic, where people started to look at the financial market slightly differently. But the major part really relates to more classic illiquid private markets, which is private equity and private debt, and lots of infrastructure.
So we're going to talk about private equity, private debt, infrastructure, the growth of those asset classes. Could you talk a little bit about, how that has developed in the last few years, and then the impact of the volatility that we've been having?
Yeah, absolutely. So whereas private equities seem to be like the first step into the market when you look at, in particular, institutional investors, when they're entering alternatives, it seems to be like what everyone feels they should be doing for good reasons, for bad reasons. I very much think there's a lot of behavioral economics in there. It's some institutional investors doing something and potentially being successful, talking to other investors, and suddenly you have like a wave that is developing. Luckily, there is a certain economic sense in financing companies, so we're at least lucky that it goes the right way. given the way the financial markets overall developed since, is that a lot of our institutional investors then were in need of cash flows, and fixed income markets didn't really provide for such cash flows, which is why private debt really had a strong rise. Secondly, with all the money flowing into the private equity market, actually we did see that there were a bit of a struggle of getting the right deal sizes to complement the inflow, and private debt sort of like provided like another way of entering, in particular buyout structures, and all the leverage that was wanted, potentially needed in these structures. And as of late, we've added infrastructure, which is basically because of the fundamental economics, and that we need to have a change in the way our energy is actually being provided for. And that is a real economic impetus that is driving the market.
And with infrastructure, it can mean investor capital being tied up for quite a long time. But allocators seem more comfortable with that at the moment.
Well, yes. If you take a pension fund or the like, usually they are very interested in, at least because of duration, to have some portion of their assets in very long-term investments, which is why infrastructure is being seen as a rather good fit. When it comes to more retail-ish investors, I would see that there is not the same appetite for long-term investment, which then kind of brings us to the difficult situation that they very often want to invest into infrastructure and the likes because they do see part of the risk premia that are being paid, which is due to the duration and illiquidity as well, or should be at least in theory. But they are not really prepared to take the risk associated with it. And at the moment, we see that the regulators throughout Europe are trying to set up new fund structures that are supposed to actually bridge this gap. But basically, they're just bridging it by asking the asset managers to have a very good liquidity management at hand to be able to actually transform this difference between the duration of the fund and the liquidity of the product that is necessary from a regulatory perspective.
Mm-hmm. As we go through, if there are any questions, do let me know. We will take them. Private credit, private debt is a massive theme at the moment. There was one top manager on Wall Street who said it was the only show in town at the moment.
What did he sell?
So what do you see as driving that, and what are some of the kind of opportunities and risks?
Well, one of the drivers definitely is an investor appetite. You can very often see a lot of sort of like basically what's happening in all alternatives in all private markets is that there are corporations, ventures, projects being financed. And the question then is, how do you finance it? And you always, it's very basic. You've got equity and you've got debt. That's like the two ways you can do it. And depending on what investors are asking for, do we want which risk position they actually are prepared to take, markets will kind of swing. There is a basic equity portion that you'll always need, but kind of the amount of debt that goes with it is up for negotiation in a broad sense. Now, with new marketplace, and historically, that was actually provided for in continental Europe by the large banks. That's something that hasn't been the same in the Anglo-Saxon world. There we had much more project finance and institutional investors all along. That's, by the way, is a very interesting discussion about how changes in the financial systems have actually impacted the way central banks are working. That's a different discussion for another day. But so there we kind of see that this change from more balance sheet-oriented financiers like the banks into these debt funds, there is one risk coming with it, because in all these projects and all these financings, there will come a day when you need to renegotiate. Usually there at some point something is difficult or you need a bit more funding for whatever reason. And at this point, if the debt fund is not managed well and there is not more capital to be deployed or no capacity to actually take care of such a situation, that can potentially have a very negative impact on the investors into this fund. So that's something I tend to recommend to investors, that if they go with a private debt investment, that they very much look into the history of these managers and how they deal with difficult situations.
Mm-hmm. Okay, we've talked a bit about ESG and sustainability today and the impact of the energy crisis. How does ESG affect alternative investments and drive potential interest?
I'm not so sure they drive interest, less the factor that infrastructure investments by some sort of general declaration seem to be perceived as ESG compatible. But if we leave that aside for a moment, I think ESG is very much a big marketing campaign. There is a big, don't get me wrong, I strongly believe in sustainability goals. I very much believe that we need to do something about the climate we're living in. I'm just not sure that the way we're doing it at the moment is the most sensible one. ESG has become a brand, and asset managers seem to believe that if they don't have it in their name or on the branding, that their product is not marketable. That may be true, I'm not so sure. But what it means is that very often we need to very deeply look into the product and see if it really is an ESG product. If there is some sort of environmental or social qualification to the strategy that is being pursued, that does, that does make it plausible to call it an ESG product. And what it has definitely done, the whole ESG branding, is that we need a lot of data, because we need to prove that whatever is being promised is actually being done. I don't know who in all the regulatory authorities throughout Europe is actually going to read all this reporting. They will want to hire lots of people, I suppose, because there is a huge amount of data that needs to go from A to B. Mm-hmm. And it's one of the big issues at the moment, finding good data, deploying it well, understanding how it works, and then getting it back to both investors and authorities.
Mm-hmm. Do we have any questions at this point? Go ahead.
So, hello, Oscar Perez from Qualitas Energy. So, during the last year, we've seen a strong increase in the interest rates, and we've seen the previous panels. So, have you seen this impacting into the valuation of the core and supercore funds in the infrastructure, that basically you need to suppose that the increase of the cost of capital should be impacting directly in the NAV of the funds?
That's a very clever question, and I think one that is very central to a lot of things that's going on at the moment. Now, if we look into the valuation of the various assets, it is a very much, first of all, a case-by-case valuation that we need to be doing. Depending on the type of financing that is being done, you need to see how much sort of like has been secured already, how much of it is volatile. So is there any real threat to the overall financing just because of interest rates going up? If you have a floating interest rate, obviously that could be very harmful to the overall financing as such. When we look into the cases we've got in our portfolio, what we tend to do, and that's true for our Luxembourgish fund at least, is that we value them at held to maturities. We keep them at cost for as long as it is possible and sensible, lest there is anything that we need to do to kind of change it, and that usually would mean that we actually lower it. But we do a mark-to-market as well, just to make sure that we actually can compare it to the basic cost approach that we have. That is possible under Lux regulation. It is not possible under German regulation, for example, where you have to have a mark-to-market valuation. And there we see that this volatility that is being input into, in particular, the debt part of these financing is causing different or difficult discussions with some of the investors. But overall, I have to say that most of our funds, and I leave out the private equity because that's a completely different play, but on the private debt side and the infrastructure have been extremely stable by the way we've done our evaluations throughout the last 12 months.
So this methodology is the same used in the US for the fixed income portfolio in the banks, isn't it? The hold to maturity.
Yes, it's, yeah.
Okay, thanks.
Do you think you could talk a little bit about the denominator effect, which had a big impact last year with all the public market volatility?
Yeah. So I don't know how sort of like familiar you are with the denominator effect, but if one looks at the alternatives, and I'm leaving out hedge funds for a second, what a recent study by, I think, McKinsey showed is that overall, worldwide in 2022, fundraising for alternative funds was down 11%, whereas in Europe it was down 28%. And that shows that, that shows a number of things. First of all, it shows that the study was done in US dollars, so any sort of like currency effect is in there as well. But secondly, it shows that the type of investors and how they're regulated in Europe means that there is a certain quota that they can invest into alternative investments, and this quota is linked to their overall assets. And part of that, those assets actually are, and obviously are in public market assets. And because of the volatility in the public markets and also the absolute downturn in the market, we then sort of like had a very much lower base, and therefore they couldn't really continue to invest into alternatives as they potentially would have wanted to, but just because of this quotas, and that's a denominator fact, they couldn't continue to do it. As all quotas, this is something we expect to normalize again, but it is something that throws light on the volatility and what it means. And I'm sure that risk management in a lot of institutions currently are looking at new ways of assessing what the amount is that they can actually invest into various asset classes, given that this volatility is at play.
So what's the difference between risk and uncertainty?
Okay, this is something I find extremely interesting, and something I think we all need to be very much aware of, that when you look into financial modeling and whether you believe the model in it by the construction or not, what you can include into the model is anything that is linked to risk, because you can quantify it, you can assess it, you can put a timing to it, a probability, be it right or wrong, but you can model it. Uncertainty is something that just happens. And who would have, if we had been asked in a poll, and I have to think back, what would it be, 4 years ago, how probable is it that there will be a worldwide pandemic that actually closes down all the world, all travel for basically 12 months? I don't think I would have seen a lot of raised hands. So that is an uncertainty, and then that just comes in. And that is what we find so difficult to model. So when at the moment, and I think that is what a lot of us are experiencing, and a lot of institutional investors, private investors, and asset managers are still not really finding ways of getting a good grip at, is how do we deal with these uncertainties? We can have all our models, but we know that at irregular times, there will be something that just hits us. And I don't know if it's just the times or it's my age, but somehow I have the impression that it becomes more of this uncertainty, and then that there is more of it. Funnily enough, in the alternatives market, we can see in retrospect that going back to 2020, the valuations, just because they are not done on a daily basis, but on a quarterly basis, actually were able to kind of don't really show this uncertainty effect, because the first valuations were due end of March. That's the beginning of the pandemic. Nobody really understood what it was going to be. And they kind of just looked back and felt, okay, it's all normal. We'll just consider it as a one-time event. 4 weeks later, everything's going to be all good again. And until June, somehow the world had already settled in our home office new reality. And again, there were no severe devaluations, at least we were aware of in our portfolio. So we kind of came through this cycle and this event without any major disruptions. That's very different since Feb 2022, when suddenly, I think it's very close to a lot of us just by geography. It was something we didn't really think would happen. So since then, we perceive that suddenly, even in alternatives that by way of construction are less volatile, we have an insertion of this type of volatility, and it's difficult, we see, for a lot of people to grasp this concept of uncertainty.
Mm-hmm, mm-hmm. We've got time for one more question. In which case, please join me in thanking Dr. Sofia.